Welcome back. You're watching HFO-TV, co-sponsored by AMF Capital, the Baljanik Law Firm, the Butler Exchange Group, and the construction firm J.R. Johnson.
Welcome back to HFO-TV. I'm Greg Frick, partner at HFO Investment Real Estate, and today we're going to have Steve Wiltshire, principal of AMF Capital, give us an update of the lending environment. We're talking here at the end of July, still in the middle of this COVID epidemic or pandemic, excuse me, and so trying to kind of have regular updates from the lending side as to kind of what you're seeing, what's changed. So thanks, Steve, for taking the time to give us an update. I hope you and the family are safe. And folks, we're not in the same room. We do have masks, but we're doing this as a Zoom call, so please, no comments about that. So thanks again. So what's going on in the lending environment now that we've, it sounds like another package may be coming through stimulus. Is that changing what you're hearing in terms of what the market feels like from a lending side?
No, I don't think the stimulus package is having a lot of impact on where we're at today. Obviously, that's a potential opportunity in the future. Lending's still very, very good. Rates are very solid. There's certainly some changes relative to underwriting guidelines and where the risk might be and exposures might be to lending institutions, but still lending is doing pretty favorable.
So and again, for our audience, is predominantly multifamily. I know we've done some transactions that were during the middle of this and have closed, and there's kind of been the reserve requirement. Are you still seeing that, or is that loosening up of requiring 6 months, 9 months, 12 months of principal and interest payments up front, or kind of what you're seeing on that regard?
Well, mixed bag. If you're talking about multifamily specifically and agency debt specifically, they are certainly still requiring some reserves in principal and interest. They have curtailed back on some things. I think, like a lot of lending institutions, when we first entered into this pandemic, was a lot of uncertainty as to what was going to happen, what potential risks we're all going to see. As this has continued forward, we've seen a little bit more favorable reactions to the market and reactions with the lending institutions relative to the debts and the mortgage holders. Still fairly strong numbers. We're still cautious as to what may behold in the future in the next couple of months. A lot of it's tied to the unemployment, the spiffs that is being sent out today to people. Right. As long as that continues, I think we can still continue to see a pretty favorable approach. There are other lending institutions, including banks and credit unions, that are starting to explore and have implemented some reserves as well. But every institution, every platform is using them a little bit different. So it really comes down to the specifics to the transaction and which qualifies for what type of lending platform.
So in our world, what we've seen lately in the underwriting side, when we're kind of looking at a project and trying to talk about pricing, what's the lender now that we're it's been April, May, June, July? How are you guys looking at the rent deferral? If I've got a 50-unit building and we've got 5 units, or we've got 4 units that are on, haven't paid because of COVID. There's an eviction moratorium. What do you do on underwriting on something like that? I mean, historically, it's accounts receivable is technically from an accounting standpoint, but what are you telling your clients on how to deal with that?
Well, collections is the biggest topic. I mean, your rent roll says one thing, what you're actually collecting is another. We're always trying to evaluate from a traditional underwriting standpoint. Does that fall into our normal underwriting when we do calculate a vacancy component, or do we have to compound it a little bit greater depending on what that true collection amount is? We've always had a vacancy and an economic vacancy, both physical and financial, in our evaluations. And,
right.
As this has gone on, the financial has had a bigger impact. So we have seen some of our lending platforms shift and maybe look at the trailing 3 months versus the trailing 6 months, versus taking an overall rent roll and just running with a vacancy number as what the market might be, or what we're currently seeing out of that specific property. So you're going to find that we're somewhat all over the board, depending upon the platform that you're choosing, because each one's going to look at it a little bit differently And if we do have one that falls, more favorable in this type of a institution like a bank or a credit union, that's going to be more favorable to your client. Then we're certainly going to talk about that a little bit more. Agency is a fantastic platform to go to. Rates are fantastic. Leverage is exceptional. We closed the deal a couple days ago at full leverage 80%. With a very, very phenomenal interest rate on a small balance deal. So there's still good numbers out there for a lot of those platforms. You just have to look at each individual deal and then decide from there what makes the best sense for your investor.
And from a lending standpoint, I mean, the Northwest is still, considered a place for them to lend money. There's nothing going on in that regard, even with.
Yeah, Pacific Northwest is a great market. Very, very solid market. Any of your major cities. We're actually even experiencing some pretty positive feedback in some of the secondary and tertiary markets because they've actually performed very well outside of the major markets. And in addition to that, Oregon's fortunate to have a couple of collegiate cities as well, and there's also some pretty favorable views on those markets doing very well through this pandemic still. So, and
then I know you're involved in not just multifamily, you do kind of all product types. I mean, maybe give our audience kind of some insight of what's going on retail and office. I mean, from what I'm hearing, industrial still seems very strong. There's just been such a lack of industrial space in this market, so to speak. But on office and retail, are we? Are lenders completely changing how they're underwriting that? What are you telling your owners or borrowers for those kind of properties?
Retail's probably taken the biggest challenge. Every product group is still available to lend on right now. It's just a little more scrutiny. Okay. Office is certainly a little questionable right now on how those buildings are going to be utilized, how they're going to be stabilized. The retail, as a general rule, certain products are good. Essential businesses certainly are still in favor. Investment grade are still doing well, but they have become a bit more of a challenge, and we might see a reduction in some leverages if we've got a pretty strong player. A big part of it, like any transaction, is the strength of your guarantor, your borrower as well. Right. So there's many different levels to look at when we're trying to decide on a project to be successful. But both products, both office and retail, are still okay. Industrial certainly is far better because there is a high demand, there is low inventory, and it's always been pretty strong because of that. We've got a pretty good market feel for those. You start looking at the other two products that you mentioned, there is some scrutiny to them, but okay. we still do have available debt for them.
And then I know Oregon, we have an eviction and foreclosure moratorium. I know Washington's looking at that. Are lenders talking about? Are they talking about like the moratoriums? There was talk about this next package federally was going to be in there. I don't think it got in there. The eviction, extending it out. I mean, is there talk about lenders looking at various markets of what's politically in place versus other ones, or is it more the economic side of it, not so much the political environment?
Well, I think it's both. It's both. Yeah. We're always going to be looking at how long the financial support is going to be there and what impact that's going to have on tenants' ability to pay, as well as mortgage holders, their ability to pay. A lot of our lenders have been working a lot with the forbearance discussions and discussions of delayed payments coming in. So everybody's adapting a little bit to that. There is some question relative to September, October, let's say, of what may occur then relative to the tenants being in place due to the moratorium, or their ability to pay not only existing debt but also previous debt, because they still have to pay that rent. So
it's not rent forgiveness. It was yes.
It's not. No, it's not. Unfortunately, that doesn't get talked about a lot, but it is something that they do have to take into consideration. And we are looking at it. How is the property going to handle that? How is the guarantor going to handle that if and when it comes? And hopefully they've got a fix for that, and we'll continue that support. Right. That saves a lot of people a lot of grief. So,
and then I know one interesting thing we've seen lately in some of our transactions has been just the challenge, especially with multifamily, the challenge of due diligence, of getting into units. It seems to me the lenders have kind of, it used to be they had a certain percentage of units they had to see. Now with COVID, it feels as if they're kind of understanding that's not going to happen. Are you kind of getting that same sense that the wish would be, hey, we'd love to see 30%, but we know we may not?
Yeah. Typically, we generally will see 10% of the unit count, and or a mix of unit types. Right now, there seems to be a comfort of taking interior photographs. We have to be careful. We do have a couple of platforms that are moving forward with accepting that today, only with the requirement that they're going to come back and look in the future.
Okay. So they've got a caveat; they can go back and look at it.
Yeah, because there is a responsibility they have to personally view it, and right now they're not wanting to stall the market; they're still wanting to keep the market moving forward. Thereby allowing us to do some either exterior visuals on their own, with the intent of coming back, or allowing us to take some photographs on their behalf. We had an appraisal this morning. Same scenario. They're allowing us to take photographs and call it good, but they're specific photographs. So,
where do you? And I know we always ask you this every time we talk to you. I mean, where do you think rates are going? Where do you think rates are going in the next? I mean, it's tough to tell. We're on uncharted waters with with what's going on, but I mean, do you feel that we're going to continue in this low interest rate environment for some point of time, or
I do. I really do. We did see a couple basis point reduction this morning in some platforms. The Treasury staying stable. The Fed came out today at their meeting and specified they're going to maintain Fed fund rate where it's at. I think we will intend on seeing some movement upward in the future, but I don't think that's going to happen. I would suspect until maybe the end of the year. My personal opinion is I think we got at least a good 3-4 months of where we're at. I don't think inflation is a concern. Quite the contrary, because we've got a concern of devaluations right now. So I think that there's going to be a pretty stable interest rate market as time goes on. Values on real estate generally have in the past fluctuated with interest rates. We haven't seen that of late, I would say, in some time, because the market demand is outpacing, what capitalization rates generally do when they fall around with the interest rates. So I think right now market values are going to stay fairly stable, as interest rates, I think, are going to stay fairly stable.
Yeah, we have not seen any kind of changing value in terms of cap rates going up or anything. I mean, I thought we may see a little bit of that with the eviction moratorium and some, and some payment collection issues, but we really haven't. I think you hit the nail on the head. It's the amount of capital that's still looking for investment in yield. And again, Pacific Northwest is a place where that capital wants to be, and we've got positive job growth still. So
market demand still has a pretty strong hold on how things trade.
So what's kind of keeping you up at night, kind of looking in the short-term future regarding the market, or is it just trying the logistics of trying to get some of these transactions completed with the the barriers of COVID and things like
Greg,
that?
that's been my entire career. There's always logistics trying to keep a deal moving and make it happen. That's
why they hire you to come in and take care of that.
We are successful. We take care of things. Yes. I think right now the biggest concern is not so much in the marketplace per se, but how the individuals are going to be able to handle this long-term endeavor that everybody's dealing with. There's still a lot of unknowns as to what the market's going to bear and how it's going to fare through this. Right now, we seem to be watching it every month and every other month. We see it a lot of overreaction to what we think is going to happen, and then we see a lot of retraction because it didn't happen. And right now, we're seeing the market settle in pretty good. Not a lot keeps me up at night anymore. By the time I get home, I'm tired enough to go to sleep. So
that's good to hear.
Good. Well, thanks for taking the time to give us a quick update. We'll do it again real soon. Like I said, we're kind of trying to do these more often now with just the changing of the market, but like I said, you just said it. It seems it's kind of, I don't want to say it's calmed down a little bit, but when we were talking back in March and April when there was so much uncertainty, it almost seems like we've kind of got a pace. Now we say that it could change tomorrow, but it seems like you said the capital markets are doing transactions. If people have refinance or purchase needs, they can reach you at the website below. But I mean, the good sign is there was that initial of unknown. Now, hey, this is the world we're in. We can start lending with maybe some different criteria, but it seems to be we're still moving ahead.
We are. I think they're starting to get a little more comfortable with where we're at. And a lot of times we see a lot of lenders, the initial reaction is going to be the worst case scenario. And as they start to see how it pans out, they somewhat settle in. That's been the mantra for the lending business for a lot of years, is to react quickly, but maybe possibly overreact, and then start to reel back a little bit. And I think the market and the industry, and as a general rule, has settled in. We've certainly nationally we've had some changes with regards to institutions pulling out of the marketplace. That has to do more so with their obligations in the secondary market, which has had some impact in the Wall Street arena, that has changed some of the dynamics as to who's in the business, who's not in the business, depending on their exposure to that side of the field. But boots on the ground, it's still a pretty favorable market. And I think it will continue that way for at least in the near future. So,
well, that's good to hear. Well, thank you again for spending the time with us, and we'll get together again. Thanks, Steve. And we'll see you next time on HFO TV.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541. Or visit our website at hfore.com for more information.